Shulman. Joel, good to see you. Thanks for weighing in here. Have you heard anything from management or the guidance that gives you clarity into what they're expecting for the next quarter and 2024?
Well, for the companies you just mentioned, I don't have specific insight into those companies. I could tell you that many of these entrepreneurs. Overall, we're very bullish. I mean, we're, the information came out last week from the Fed was encouraging that they're probably going to pause for at least the foreseeable future. The job report was encouraging in terms of the economy seems to be slowing down. We think we're moving to a Goldilocks scenario, and we think this is going to be very encouraging for the markets going forward. We had a big week, Wednesday, Thursday, Friday. Many stocks were up, 10, 15%, and we see clear sailing for the rest of the year. We think we're going to have a year-end bonus, a Christmas rally for the year-end, and we think it's already started. So we think this is risk-on market. I mean, we haven't seen an encouraging market like this in a while. So we're encouraged for the remainder of the year. And as you're showing on the screen right now, the long bonds have come down. The 10-year and 30-year, which were either approaching 5% or above 5%, have come down quite a bit from their highs. And whenever you see the long bonds coming down, that's encouraging for risk-on environment.
Yeah, I mean, it's come way down. The 10-year now at 4.617%, down 4.5 basis points this morning as we see yields come off of that 5% number, which was just there a week ago. Would 5% cause you to move money into fixed income?
No, I mean, if it looks like the interest rates are going back up, then long-term treasuries are the last place we would want to be. With rising interest rate environment. However, it looks like things are going to be somewhat stationary. We've got a big Fed. We've got a CPI number coming out November 14th. That's going to be the next major catalyst in the next week besides earnings. If CPI starts coming in soft, and the real estate number is the one that we've been focusing on for the last year, with mortgage rates pushing close to 8%, we think real estate is going to be soft, although people are reluctant to give up their 3% mortgages that they got during COVID. So we're seeing tight inventory, which is keeping the prices somewhat stubborn. Unfortunately, they're keeping them somewhat high in the marketplace. But as inflation comes down, as real estate starts to come off their highs, we think there's going to be a very good market here for the remainder of the year.
Mark Tepper, jump in here. You agree?
I'm kind of torn, if you go back to last year and you look at the holiday shopping season, it was strong. Now, here's the issue. Normally, any of that credit card debt increase that consumers accumulate in the months of November and December, it gets paid off in January. And that's been the case going all the way back to like 2008 or 2009. And after last holiday shopping season, you go to January of 2023. For the first time since 2008 or 2009, that credit card debt did not get paid off. So, Joel, what do you make of that? I mean, it does seem that two things can exist at once. We can still have a strong holiday shopping season while accumulating more debt. But at some point, don't you think that doesn't end well?
Well, Mark, you make a good point. I mean, we recall last January, February, we peaked last year in the markets in mid-February, and then we had a series of issues that caused the markets to go down from their highs in February, March, and then they came back in April, May. So you're right, the credit card debt is an issue. It is down. People compare this, at least earlier in the year to the 2009 crash. The credit card debt is way off from the highs what we had, 10, 15 years ago. And with interest rates now stabilizing, we see that with interest rates stabilizing and hopefully coming down a little bit, we see the markets. I think they're going to be responding fine. And again, when you mentioned the data in terms of coming off of Christmas shopping with lots of debt in January, February, we still will see a very strong November, December for the markets. We think it's going to be risk on with longer duration and more speculative stocks, and then that issue will come in February, March.
If you expect a Christmas rally and you expect we're going to get a year-end move up in stocks, how do I want to play it? Where are the areas that will lead that rally, and how are you allocating capital?
We're now moving, and again, we haven't said this in a long time. We were being somewhat cautionary until recently. We're risk on. We're going risk on. We're going more speculative stocks. That's what we were seeing in the last few days. We're going out in duration. Out in duration means you're going to go down in market cap. So we're going more away from the megas. We're going more into the smaller large caps, 10 billion, 15 billion, and the mid cap and small cap. We think are going to have a very strong year-end rally. The small caps, mid caps have been beat up in the last few months. They were down 10, 15, 20% for many of these companies in September and October. They had a very tough month. We see them coming back, and we see them potentially hitting the highs for the year. So there's a lot of room for these stocks in the next month or two.
All right, good news. We'll be watching that one. Thank you, Joel. Great to see you. Joel Shulman joining us this morning, ERShares. Stay with us. We'll be right back.